Welcome to Renegade Inc., the show that allows us to think differently. The average Briton is only ever about 2 sentences away from discussing house prices. Why? Because the British housing, or land market, is utterly dysfunctional. Just ask the Bank of Mum and Dad. When Thatcher resuscitated the idea of a property-owning democracy, not even she would have imagined the scale of inequality that those 3 words would drive. So how did we get here, and why, in the world's 5th largest economy, can so few people afford to buy their own home? Joining me to work out why it's likely that you can't afford a home is the former insurance valuation specialist at the Bank of England, Dean Buckner, and the writer and economist Josh Ryan Collins. Gentlemen, welcome to you both. Dean, when you look at the British housing crisis, as it is often referred to, what do you see? How do you see the British housing market, the British housing situation?
I see the situation as being house prices are very high.
Right.
And higher than most young people can afford.
And does that translate into crisis, and if so, how?
Yeah, it translates into a crisis if people, have to rent when they want to buy, or if they have to stay in their mum and dad's basement when they would prefer to buy or to rent. So that's clearly a problem. When I say we can't afford, interest rates are very low at the moment. My daughter recently got a mortgage for 1.8% at 5 years. Multiply that 1.8% by even quite a high number, and you translate it into something that's sort of half what you pay on rent for the same house. It's not necessarily a problem that people can't afford it, it's just that the asset values are very high, and if you don't have the right sort of earnings to price multiple, which the bank demands, then even if you can afford to pay the mortgage on the house, they won't let you have a mortgage. We got into that situation with the price of housing rising across the UK and across the world, actually, from about 1998 onwards. We had a bit of a housing recession in the mid-90s, which I was part of. We saw housing rising and some quite ridiculous mortgage structures being put in place up until about the crisis. Then, as we know, it all went horribly wrong, particularly in the US. Housing prices collapsed again. The central banks around the world then said, well, that's a bit of a problem, isn't it? How do we solve that? Well, just lower interest rates. Classic Keynesian thinking, a bit of a demand problem. People aren't buying enough, so let's restore confidence in the system, reduce interest rates, and at the same time with QE, create the biggest sort of sovereign bond bubble we've had in history. And the theory was that would get us out of the crisis.
But in fact, what has it done?
It's created very high asset prices.
The idea here, Josh, is Say's law, I suppose, that supply creates demand. Is that the case?
No, not in the case of housing, because houses are built on land, and land is quite a unique economic commodity. It's inherently limited in supply. If there's more demand for iPhones, Apple makes more iPhones, or it raises the price and you find an equilibrium price. When there's more demand for housing, it's usually in particular areas, and the land in those areas is inherently scarce. It's finite, basically. So the result of creating more demand, as Dean's talked about, is actually a very direct increase in house prices, mainly driven by the land actually underneath.
Why is it that we have such a blind spot when it comes to land, specifically in the economics discipline?
I think this goes back to the sort of emergence of neoclassical economics and neoclassical growth theory at the end of the 19th century. People like John Bates Clark, for example. Because actually the classical economists, John Stuart Mill, Ricardo, and Adam Smith as well, had acute understanding of this unique property of land, that it was inherently finite, and that essentially landowners could extract the value that's being created in a growing economy by building roads or improving in farming techniques. Whoever owned the land could extract more and more rent as the value of that land rises. But the emergence of neoclassical theory, they argued essentially that there wasn't really a fundamental difference between land and other types of economic commodities, so what was loosely called capital, essentially. That in the long run, the marginal return to land was no different from the marginal return to other forms of capital. And this is marginal productivity theory, that every commodity earns its own marginal product over time. And as a result, we ended up changing policies. So, for example, not taxing those land value increases from economic growth.
When you mentioned John Bates Clark,
The other point that Michael Hudson makes is that John Bates Clark also didn't make the differentiation between earned and unearned wealth.
Yeah, that's right. So the sort of founding principle of marginal productivity is every product sort of earns, or every commodity earns its own product. I mean, human effort, whether it's building a car or enjoying increases in value from holding land, there's no fundamental distinction between those. So that's a problem when it comes to issues like wealth inequality and taxation, as I mentioned.
By the 1870s and 80s, there was a lot of pressure in all countries, but especially in the United States, by socialists on the one hand and followers of the journalist Henry George on the other, wanting to tax away the economic rent and use that as the tax base instead of taxing labor and industry. And so John Bates Clark wrote about the philosophy of wealth, and he said, "There's no such thing as unearned income. Everything that the economists before me have written is wrong. Everybody earns exactly what they contribute to national product. And that means that whatever their earnings are will be added to national product."
I mean, I think there's a dawning realization that there's a problem with the level of rent extraction generally across the economy, and land is perhaps the area where it's most obvious. The complication, of course, is that this rent extraction process is not simply a case of, the 1% up here extracting from everyone else when it comes to housing. It's actually the middle class are also extracting rent. The middle class don't pay any tax in this country on their primary residence, in contrast to all other forms of financial assets. There's a sort of democratic problem in the sense that it's hard to get the middle classes to vote to impose a tax upon themselves, basically.
Right. It was proposed, I think, in the 1960s by the Labour government that this sort of unearned income on the rent that you pay yourself to live in your own house should be taxed. That was not a success. That did not get off the starting ground. There is a kind of anomaly, you're right, that if you were to be even-handed, you would tax, if you want to tax income, maybe you shouldn't, but if you wanted to tax income, you would tax that component of income as well. And then you could save if your pension any kind of asset or security you wanted, in bonds, in stocks, or in housing, whatever you like, and you would be taxed equally on it. There would not then be the incentive to treat your own house as a pension. There is a case for saying that. Is there a political case for saying that? I don't think so.
I think there is a growing realization, even amongst the middle classes, that the opportunity that they've enjoyed in their lifetimes to buy a house at a reasonably young age, in their late 20s, early 30s, live in it, pay off the mortgage, so that by the time they retire, they haven't really got a mortgage, retire in relative comfort. That opportunity is not going to be available to their children. And that is politically significant, I think. Take London, for example. It's almost now a renter city. It's basically impossible to buy a house in London and many other cities in the UK without a major handout from the bank of mum and dad.
There is a problem here in that there is considerable evidence, both anecdotal and academic, that people are treating housing as a pension. Part of the reason people don't invest enough in their pension, I think, is they don't trust the pension system. They don't trust the people they're giving the money to treat it fairly, and they don't trust the government not to tax it in some way in the future. So you cannot blame the middle class, if you like, for treating its own house as a pension.
This whole thing, there seems to be just concession after concession within this system. Because we haven't got the fundamentals right. There's help to buy, which should actually be called help to sell, and there's a bank of mum and dad, and there's the pension issue, and there's a persistent sort of concession and a give out, and a little hedge here and a hedge there. I mean, it's a dog's dinner, isn't it?
I mean, fundamentally, I think you can think about two historical epochs in sort of advanced economies generally around the role of the state in housing. So you had a sort of golden period, really, from the post-Second World War up to the 1980s, where actually the state focused on subsidising supply rather than subsidising demand. So they did stuff like buy up land at agricultural values and build, these garden cities, for example, quite interesting cooperative models where the land values are separated from the wider financial markets. And, massive social housing, building programs, the creation of suburbs, investment in infrastructure, to create more land effectively around cities. This was a hugely successful period where actually the price of housing didn't rise significantly above income, and more people could get their own home. Or social housing or rental housing. There was no favouritism across those different tenures, essentially, because there was actually an imputed rental tax if you did own a home. So you would effectively pay what you would have paid had you been renting. That was removed by the Labour Party in 1963, and there was forms of tax on property. Then in this sort of 1980s up to now period, you had a reversal. There was a shift away from the state playing this active market-shaping role in the land market and the housing market, and a decision actually the market itself could do the job if the state stepped back. That was something to do with governments perceiving to run out of money in the 1970s with the inflation, etc., running up larger deficits. And the solution was not to say, oh, maybe not everyone can own a home. The solution was to subsidise the demand side by allowing banks to essentially come in and provide the funding that previously the state had been providing. But of course, the banking system has a different approach to funding housing and funding the purchase of homes. They're fundamentally interested in making money, making a profit, and they're interested in having a secure collateral to back up that loan. So what banks do when they make a loan, a mortgage that is, they ask for the land, the property as collateral, and they make a loan based on the size of that collateral and the perception of whether the person can pay their money back or not. But of course, when banks make loans, they create money. They create new purchasing power. They don't take money from savers here or savers there. And of course, when you pump new money into a finite, limited, inelastic asset like land, like property, the inevitable result, if the money's going in at a faster rate than the growth in the economy and the growth of incomes, will be house price inflation.
Welcome back to Renegade Inc., the show that allows us to think differently. Before we talk more about why you can't afford a home with the financial economists Josh Ryan Collins and Dean Buckner, let's have a look at what you've been tweeting about in this week's Renegade Inc. Index. First up, from repairers of the breach, housing costs absorb more and more of my take-home pay, so therefore I survive on less. I eat once a day, do not purchase new clothing or shoes unless absolutely required. And this is from a piece on the untold stories of the housing crisis. Next, from Caroline J. Malloy, she says, the main reason the tubes and trains are so crowded, even though the London population has decreased over the past few decades, is the housing bubble means no one can afford to live anywhere near their job these days, so everyone has to commute for miles.
I think one problem is we're still very London-centric. You know, house prices are probably cheaper in Glasgow, probably cheaper still in the Outer Hebrides. We have no plan for sort of putting the good jobs in places other than London.
Next, from November Allen, this is in response to an Irish headline stating that rents continue to rise with 11.3% national increase. In his view, stop talking about rents like they're some kind of sentient being. The headline here is landlords increase rent by 11.3% in the middle of a housing crisis. Is that fair?
I don't think it's entirely fair to blame landlords in the sense that, you know, the government needs to regulate to prevent rents going up at a faster rate than incomes. So that's what happens in Germany and many other countries. Rents are regulated.
Finally, from Henry Pryor, I wonder how this will age. This is an advert for Galliard's Help to Buy a superb value London living studio, 1 and 2 bed apartment starting at £299,000.
Essentially, we have a sort of development model where developers compete with each other to buy land, and then what they want to do is build on housing to maximise their profit. So they're not going to build houses that they, you know, are suitable for poorer people because they're going to make less profit. Right? They're going to build the most expensive housing they can, and they're actually going to release the housing at a pace that maintains demand in the market rather than at a pace according to people's needs.
Leads us beautifully onto a book by a guy called Josh Ryan Collins, which is called Why You Can't Afford a Home. Pitch it.
So basically the idea of the book is to push back against these classic explanations of why housing is so expensive, the supply side arguments, just need to build more homes, there's too many immigrants. And it says that actually the prime cause of house price rises, since the 1990s especially, has been this deregulation of the financial system and this feedback cycle where banks create money, pumps up house prices, people need bigger mortgages to buy homes, banks lend more, etc., etc. And it's how you break out of that cycle.
Why You Can't Afford a Home by Josh Ryan Collins. Everyone is allowed their own favourite animation, and on this show we have ours. It's a housing animation, and this is it.
Within the Anglo-American property-owning democracy, the homeowner became a captive voter, but more importantly, a consumer. Lulled into the irrational belief that we can get something for nothing, millions bought the property dream, and almost everyone stopped saving for a rainy day, when bankers and economists claimed ever-increasing house prices would pay for everything. Infatuated by this insane belief, people borrowed massively to buy dream homes and build speculative property portfolios, whilst government, real estate agents, and banks made billions out of transactions because house prices could forever go only in one direction. Everyone spent this free money, but without a moral compass to question the rights and wrongs of taking it or where society was headed. Thousands of people stopped going to work and sat at home looking for more speculation opportunities. Pandering to speculators, populist governments reshaped taxation to favor predators in search of rental spoils and penalize the productive minority who produced actual wealth by going to work.
What we're trying to make the differentiation on there is the difference between the speculative economy and the real economy. Dean, as we look at the UK economy now, can we be glib enough to split it like that?
I'm quite sanguine about, the capitalist economy in the West, the Western economy in general. It goes through these periods of sort of excessive enthusiasm and animal spirits, if you like, and the history shows, if you go back to the Napoleonic Wars, that it all goes horribly wrong at some point, and then it sort of corrects itself. The system sort of works. It's not an ideal solution, but it sort of works. And the question is, what would you put in its place? That would be my view.
Well, but when you say the system sort of works, we are presiding over one of the greatest credit bubbles, and certainly housing bubbles, in human history. We're not too far away from comparisons with Japan. Because as we know, in 1989 to 1990, Japan was at the same sort of level, without all the synthetic derivatives that are now in the Western markets. And look what happened there.
If you look at the 19th century, you see these sort of periods of a bubble, an extension of the market, animal spirits. It deflates very rapidly, and then it all sort of gets back to normal. What we're seeing here is somewhat different. It's not the market creating this, it is the central banks.
So where next for the UK market?
At some point, if we have inflation, the Bank of England is going to be faced with the problem of what to do, because its main job is to work for the good of the people of the UK by promoting financial stability. And one of those objectives is reducing inflation. We'll keep putting a lid on inflation. That is going to be very hard to do without increasing interest rates. And that is bound to have an effect on housing. And that could be disastrous. Alternatively, we're going to sort of weird Japan situation where interest rates are kept low for really a very, very long period, 1990, 2000, 28 years, nearly 30 years, or very, very low interest rates and continued deflation. So that's the kind of choice we're facing.
Not exactly a cheery outlook, is it? Because, answering this question, why can't you afford a home? The point is, many people might be able to quite soon if this house of cards collapses.
I'm not sure it will collapse because I don't think either governments or central banks will allow a sort of major collapse.
So those who promote this free market economic idea also promote the idea of getting involved in these markets and keeping them propped up.
Yeah, and also because the UK economy is now so dependent on house prices not falling or increasing, partially because of, as you had in your video there, mortgage equity withdrawal. That's a huge contributor to GDP growth. It keeps consumption up. Remember, 2/3 of GDP output is consumption in the UK. It's the banking system likes to collateralise all their loans against housing as well, even loans to SMEs. Often the bank requires the SME to put up their house. So if you have a fall in house prices, you're going to have a much wider crippling of the wider economy because your banks will stop lending. You'll get fire sales of assets, etc. So there is a sort of really fundamental problem. We do need, I think, a very gradual deflation of house prices and a gradual closing of the gap with incomes, essentially.
You often hear that we're going to have an orderly landing when it comes to the land market, a soft landing.
Yeah.
It doesn't often happen.
I think what we need to do is actually have a stronger role for the state, whether it's sort of the local state or the national state, in putting a sort of backstop to prevent this very rapid decline in land values. So, for example, if there is another sort of crash, governments could offer people who are facing negative equity the opportunity to carry on living in their home, and the government actually buys the equity in the home, and the homeowners pay rent to the state, effectively.
So
that's an option of
it's
sort
a
of
later stage Help to Buy.
Yeah, it's a more sensible approach.
It's another concession.
Yeah, but then the state owns the land or the property, and the state has an asset when the value increases again. But we do need to start thinking a bit more creatively. And my main recommendation actually would be to also start thinking about how you create demand in the economy outside the housing sector, right? And then that means a bigger role for fiscal policy.
Where would you aim that policy recommendation?
Well, infrastructure, green energy. We have a very poor record on innovation generally and productivity relative to our advanced economies. We need more early stage investment in R&D. We do need to build more affordable housing. That could be another role for the government. I do think we need different institutions. We need different banking institutions. We need, a big state investment bank. We need regional or banks that understand local economies and don't always demand collateral. They actually do relationship lending where they get to know a business, know the local economy and don't lend again.
The German model.
Yeah, the German Sparkassen or cooperative banks model is a good example.
Dean, just explain to us what equity release is.
We're going right back to the need that people feel for a pension, and that the house, for many people, is a kind of pension. What equity release allows you to do is to monetize that house by borrowing money at quite penal rates, 5%. Some cases 6% for the early versions of these products. That is then compounded up. So the Canadian compound interest, unlike a normal mortgage, is that it doubles at 6%. It doubles every 12 years. So even if you take a relatively modest loan out, say 25% of the value of your house, that will approach the current value of your house within 24 years. So people are doing this. What is the problem there? With equity release, it is what's called the no negative equity guarantee, which means that the provider, the lender, will get back the minimum of the compounded loan value, which will compound pretty well and very profitable for the first, say, 15 years of the product. The minimum of that, or the value of the house, whichever is smaller, meaning that if the person lives long enough, you'll have a generation of sort of homeowners who don't own their own home but are still living there, and with the providers of these mortgages unable to collect any interest on it. And the problem there is that you're exposed essentially to house price fall. Not just house price falls, but house prices not continually going up. So in the 2000s, we had the problem that house prices were going up and banks were effectively capitalising on those gains in house prices. But at current values, with equity release, it's even worse than that. You are effectively forecasting what we think the housing market will be in 25 years' time and recognising a profit on that. And that's got to go horribly wrong, right?
Really badly wrong.
I'm not so comfortable with Josh's idea that, a stronger government or more government intervention or regulation is going to help very much. And I always said, and I've worked as a regulator for 15 years, if you feel you have a problem, then don't ask the regulator to solve it, because they will try and solve it. I'm not saying the market is much better, but it's probably slightly better.
There is a risk to just say the state can sort it out, because we've been talking about the state has played this not very benign role certainly since the 1980s.
They got it a bit wrong. Well, a fair bit.
Yeah, well, as I said, they moved from subsidising supply, which made sense, keeping land values low, to subsidising demand and pumping up land values. And of course, a lot of that is to do with democracy and, home ownership being a vote winner. But as I said earlier, we are coming to a point where systemically it's not working anymore. We have this fall in home ownership in the UK from about 70% in 2003 to closer to 64% now, replicated actually across all the Anglo-Saxon economies, actually. So it's quite clear that this system that we have of this very strong policy emphasis on encouraging home ownership, coupled with this highly deregulated banking system that's increasingly shifted away from funding firms, the real economy, towards funding real estate assets, is actually not compatible with higher levels of home ownership, rather the reverse. It's leading to lower levels of home ownership.
Don't you think it's absolutely ironic that the governments since the sort of mid-80s have only talked really about the economy, they haven't talked about society? And what we're talking about in this conversation fundamentally are the effects on society. When you marketise, as we have done the housing asset class in this way, ultimately society suffers.
I think actually there are some chinks of light, actually, in the UK, for example. Both major parties are now talking about land value capture for the first time, seriously. What I've seen less of, actually, is this problem I was talking earlier about the institutional structures of the financial system and the banking system. In the UK, we still dominated by these 5 big banks. They all do the same kind of stuff, basically mortgage lending or big loans to other financial corporations. That's where I don't see stuff happening. That's why I'm a bit more pessimistic.
So the mantra is that if house prices go down, and it's been the theme of this conversation, that actually it's a bad thing. The point is that we're in a situation where house prices have to go down, and actually it's not a bad thing.
It will help our children, or at least my children. It will help them.
And
buy.
you, as a lot of, and I'm sure you speak on behalf of a lot of other boomers, to say actually house prices going down isn't going to be as catastrophic as we think it's going to be.
It will be catastrophic, but it will help. It won't be a good thing, let's say.
Yeah, well, let's divide this. It's not a good thing for the economy, but it's probably a really good thing for society.
It's definitely a good thing for society. It ought to happen. We just need to think of, or somebody, not me, needs to think of ways in which it could happen in the least catastrophic way.
Yeah, I think he's right. It does have to happen. And I think the key thing is that we find ways of creating demand and economic activity, in other areas of the economy, so that the fall in demand that a house price deflation will inevitably generate is counterbalanced. And that, again, is where you need a more active role for the state, and you need different kinds of institutions, different kinds of banks.
And we see an entrepreneurial renaissance.
I hope so.
It'd be a wonderful thing. Thank you both very much.
Thank you.
That's it from Renegade Inc. this week. You can drop the team a mail, studio@renegadeinc.com, or you can tweet us @RenegadeInc. Join us next week for more insight from those people who are thinking differently. But until then, stay curious.